Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Microsoft shares, wow. They plummeted somewhere between 11% and 12.06% today, January 29th, 2026. In just one incredibly violent trading session, the stock crashed down to a range between, 423 and 431. I mean, to put the sheer magnitude of this into perspective, we are not just talking about a bad day. We are looking at the 7th largest single-day drop in the company's entire history, and it's the 2nd largest market cap loss on U.S. record. We just watched nearly $400 billion in shareholder value just evaporate. And we have to be very clear about the catalyst here, because this wasn't some macro event. This wasn't the Fed. This price action is 100% specific to the fiscal Q2 2026 earnings report from last night. What we're seeing is a fundamental conflict. The company technically beat on revenue, $81.3 billion, but the market is just violently rejecting the cost of that revenue. Investors looked at the capital expenditure strategy, the price tag for this AI war, and they just slammed the brakes.
Which, I have to say, is a completely hysterical market overreaction to what is a massive and frankly necessary infrastructure build-out. The market is punishing Microsoft for building the very moat that will secure its dominance for the next decade. If you just ignore the sticker shock for a second and look at what they're building, this is the foundation of a future monopoly.
See, I come at it from a completely different angle. I think this is a rational, maybe even overdue correction. It's finally exposing two critical weaknesses: the circular accounting risk with OpenAI, which we absolutely need to dig into, and just a fundamentals deterioration of the business's profit margins. The market is waking up to the fact that revenue growth is getting exponentially more expensive. You call it a moat, I'm starting to think it's a money pit.
Okay, let's break that down. Because if you look past the panic, the headline numbers were actually stellar. Revenue was up 18% year over year. That beat their own guidance. And if you look at Intelligent Cloud, which is the engine room for this whole thing, Azure grew somewhere between 38 and 40%. For a mature $3 trillion company to be growing at that scale, I mean, that's almost unheard of.
Growth isn't the issue, though, is it? It's the cost of that growth. You can sell dollar bills for 90 cents all day long and show fantastic revenue growth, but you'll go bankrupt doing it.
Oh, that is a massive exaggeration. The demand signal here is undeniable. Commercial bookings surged 230%. That is not a typo. We're seeing huge long-term commitments from enterprise customers, often well over $100 million per contract. Right now, Microsoft is what they call capacity constrained. They literally cannot deploy service fast enough to meet the demand. When you have customers lining up with 9-figure checks, a 12% stock drop, it just feels like a massive mispricing of the opportunity.
I'm sorry, I just don't buy that the demand signal justifies what we're seeing on the balance sheet. Revenue growth is totally irrelevant if it costs too much to generate. You mentioned bookings, okay, but look at the capital expenditure line. CapEx is up 89% year over year. That is a shocking figure. We're talking about a build-out that is just eating the company's efficiency alive.
You have to spend to scale. It's the exact same playbook as 2015 when they first built out the cloud. Everyone said Satya was crazy then too.
But look what it's doing to the margins today. The Microsoft Cloud gross margin fell from 72% down to 67-68%. That's a significant erosion. Any efficiency gains from their software are being completely consumed by the cost of scaling this AI infrastructure. The market is realizing this AI tax on profitability might just be permanent. You're spending 89% more capital to get 18% more revenue. That math doesn't scale.
It scales if you're building the utility that underpins the entire global economy. It's capital intensive now, yes, but once it's laid, the cost drops. But I know where you're going with this. You're worried about where that revenue is actually coming from.
I think worried is an understatement. This brings us to the elephant in the room. We have to talk about the OpenAI risk, because the Q2 earnings revealed a data point that I think spooked institutional money more than anything else.
The remaining performance obligations.
The concentration within them specifically. So RPO is basically the company's backlog of guaranteed money. It hit $625 billion, sounds great, but they revealed that roughly 45% of that, about $281 billion, is concentrated with one single partner, OpenAI.
This is textbook circular economics.
Explain what you mean by circular, because to me it looks like a strategic lock-in.
It's simple and it's dangerous. Microsoft invests billions into OpenAI. OpenAI then turns around and pays Microsoft for cloud compute on Azure. Microsoft books that as revenue. It's moving money from the left pocket to the right pocket and calling it growth. You're booking revenue from money you essentially just lent to your customer.
That's how you incubate an ecosystem. You seed the market to create the standard.
It's a dependency loop. If OpenAI falters or, if they fail to get this massive new funding round, nearly half of Microsoft's future book of business could just vanish. And we know OpenAI is burning cash. The losses from that investment hit Microsoft's EPS by 41 cents this year alone. You are financing your own biggest customer.
I see the risk on paper, but if OpenAI was a toxic asset, you wouldn't see the world's most sophisticated capital fighting to get into their new funding round. We're hearing NVIDIA is in talks to put in $30 billion, SoftBank another $30 billion. I mean, these aren't unsophisticated players.
Fair point, but that also highlights another threat.
Even Amazon is supposedly in talks to invest. And that, frankly, proves the asset is highly desirable. Amazon investing in OpenAI is a threat to Microsoft's exclusivity, which, ironically, proves that holding the primary position is a massive advantage, not a liability. If it were just a money pit, Amazon wouldn't be trying to buy in.
Unless Amazon is just trying to dilute Microsoft's grip. If Amazon gets in, OpenAI starts using AWS, and suddenly that $281 billion RPO doesn't look so secure. But let's pivot to the hardware. The bull case always comes back to the idea that eventually the chips get cheaper and Microsoft stops bleeding margin to NVIDIA.
Exactly. And that's what the Maya 200 catalyst is all about. This chip they unveiled on January 26 is a monster. It's fabricated on TSMC's 3-nanometer process with 140 billion transistors.
Specs are one thing, deployment is another, silicon is hard.
But the specs drive the economics. Maya 200 delivers over 10 petaflops of performance, but more importantly, it offers 30% better performance per dollar. This is how you fix the margin compression. You stop renting the shovel from NVIDIA and you start manufacturing it yourself. Vertical integration. This is the playbook.
It's a compelling narrative, but look at their purchasing behavior right now. Despite unveiling this chip, Satya Nadella admitted on the call they still have to buy NVIDIA chips because of shortages. They are nowhere near independence, and they are losing the valuation war because of it.
It's a heterogeneous infrastructure. You need both. NVIDIA for training, Maya for inference. It's a smart mix.
But look at the market cap comparison. The arms race has a winner, and it isn't Microsoft. NVIDIA is sitting at over $4.5 trillion. They sell the shovels. Microsoft has fallen to number 4, behind Apple and Alphabet. The market is voting with its wallet.
Market cap rankings fluctuate. That's a vanity metric.
But the valuation multiples tell the real story. Microsoft is at, 29 times forward PE? NVIDIA is over 40. Microsoft is losing that safety premium it used to have. Investors are saying, if I want AI, I'll buy NVIDIA. If I want safety, I'll buy Apple. Microsoft is stuck in the middle.
I disagree. I think 29 times PE is where it gets interesting. This sell-off has de-risked the stock. 29 times for a company growing revenue at 18% with 230% backlog growth. That looks attractive next to NVIDIA's nosebleed 40 times. But let's talk about who is actually selling, because I think the smart money narrative is being misinterpreted.
Okay, let's look at the smart money flow. We saw some very disturbing signals in the dark pools right before this drop.
Dark pool data can be noisy.
This was a scream, not a whisper. On January 23rd, the off-exchange short volume spiked to 46%. Right before earnings, it was nearly 40%. That's heavy institutional hedging. The big players were protecting themselves against exactly what just happened.
Well, they were just betting on volatility, not direction. That's standard for a big earnings print.
And then look at the insiders. This is the part that genuinely concerns me. Satya Nadella has sold about $75 million worth of stock recently. Brad Smith sold nearly 50,000 shares. And do you know how many open market purchases there were by insiders in the last 90 days? 0.
That's a classic misinterpretation. Those are almost certainly 10b5-1 pre-scheduled sales for tax reasons for diversification. It doesn't signal a lack of confidence.
But zero purchases when the stock is dipping? That sends a message. Management is taking liquidity while retail investors are told to hold the bag. If they believed this was a steal at 29 times PE, they would be buying. They aren't.
I have to push back. Vanguard and BlackRock still hold enormous positions, something like 17% of the company combined. And you have sophisticated players like One River Asset Management, increasing their holdings by 1,300%.
But they were using complex option strategies. It was a volatility play, not a directional bet. They made money on the chaos, not on the fundamental health of the company.
Okay, but let's talk about what the broader market actually expected, because this supports my view that this was a panic event. If you look at the prediction markets like Polymarket, the crowd was completely blindsided.
I track Polymarket closely. I think the signal was mixed.
On the price target, it was unequivocal. Traders put a 100% probability on the stock staying between 465 and 480. The downside risk to where we ended up, 428, was priced at only a 6% probability.
That just means the traders were wrong.
It means the drop was a black swan event sentiment-wise. The actual move was double what the options market implied. That's a just panic, not a rational re-rating. The fundamentals didn't change 12% overnight. The psychology did.
But you're cherry picking. Look at the market cap war prediction on Polymarket. That market correctly predicted Apple had a 94% chance of being the most valuable company by month's end. Microsoft was at 4.2%. The crowd knew Microsoft had lost momentum even before the earnings. The sentiment was already broken.
Losing the top spot doesn't mean the business is broken. But I will acknowledge there is genuine friction in the regulatory environment.
It's more than friction, it's a war on three fronts. You've got the tech war, the capital war on margins, and now a legal war. You have the FTC and EU looking at tying AI to office. You have the New York RAISE Act, and now the UK CMA is recommending a strategic market status investigation. This is a coordinated global tightening. It's sand in the gears right when they need to move fast.
Regulatory headwinds are a constant. They survived the DOJ in the 90s. It never stopped them.
The difference is in the 90s, they had 90% gross margins on Windows. They had room for error. Now they are fighting for every basis point of margin in a capital-intensive war. They don't have that same cushion.
I think that brings us back to the core disagreement. You see a company stretch thin, bleeding margin. I see a company aggressively seizing the next technological epic.
And I see a company that has promised the moon and is paying for the rocket fuel with a credit card.
So to summarize where I stand after this historic drop, the sell-off takes Microsoft's back to a reasonable valuation, 29 times earnings. The B2B mode is intact. You have 230% bookings growth. The shift to the Maya chip is underway, which will address the cost issues over time. This feels exactly like the move to the cloud a decade ago. Expensive at first, but ultimately a massive wealth creator.
And I remain unconvinced. I believe the infrastructure paradox is real. Growing revenue now requires exponentially more capital, which is permanently depressing margins. You've got insider selling, 45% of your order book is tied to a cash-burning startup, and a regulatory target on your back. The risk profile of Microsoft has fundamentally changed. This is no longer the safe haven stock it once was.
Well, we can agree on one thing. That circular economy metric, the OpenAI RPO number, that's going to be the single most important thing to watch in Q3.
Absolutely. If that funding round wobbles, or if that $281 billion number starts to look shaky, this 12% drop will look like a warm-up.
A sobering thought to end on. We'll be watching.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.